The top business stories live from the Sky News City studio. The Chancellor plays down the chances of big tax cuts in his budget on Wednesday. I've been speaking with one of the city's top bankers. Insurance giant Aviva returns to the Lloyd's of London market for the first time in more than 2 decades. Plus, breaking news concerning the Telegraph. Our City editor Mark Lyman will be with me. Good morning, this is Business Live with me, Ian King. We begin today with breaking news concerning the Telegraph Group. It comes from our City editor, Mark Lyman, who joins me now from Westminster. Mark, what have you got?
Yeah, some significant developments this morning, Ian, in relation to the battle for control of the Daily Telegraph. What I understand is that officials at the Department for Culture, Media and Sport have warned that the recent removal of the Daily Telegraph's chief executive and chief financial officer were in breach of a government order requiring that such changes be approved by the Secretary of State, Lucy Fraser, before they took place. Now, in a letter that went to lawyers acting on this deal last week, I understand that officials at the DCMS said that the removal of Nick Hugh as the Telegraph's chief executive and Cormac O'Shea as the chief finance officer breached an order that was put in place late last year, and that also the appointment of Anna Jones as the Telegraph's new boss also breached that government order. Now, officials from the government said that the Secretary of State had decided not to take any further action on this occasion. But, and I quote in, any further breaches may lead to enforcement action, including the imposition of a penalty, which may be up to 5% of the total worldwide turnover of the enterprises owned or controlled by the person on whom it is imposed. Now, to put this into context, the Telegraph in 2022 recorded a turnover of just over £254 million. So on that basis, a fine that could be imposed for any further breaches of the government order would amount to about £12.5 million. And this all illustrates the ongoing tussle for control of the Telegraph. Next week, Ofcom and the Competition and Markets Authority have been given a deadline by Ms Fraser to report back on whether the takeover of the Telegraph by Redbird IMI, an Abu Dhabi state-backed vehicle, would undermine press freedom in this country. Of course, the deal has attracted vehement opposition from Conservative politicians and Telegraph journalists themselves. Many observers expect that after that 11th of March report, that the Competition and Markets Authority will be asked to conduct a more in-depth Phase 2 investigation, which would effectively kick the can down the road by several months, much closer to a potential general election, which of course is important in the context of the Telegraph's traditional Conservative support. As I say, Ian, this intervention by the government seems to me to be quite a significant move. In a statement, a spokesman for the independent directors have told me this morning that it is the fiduciary duty of the independent directors to act in the best interests of the Telegraph Media Group, and we will continue to do so. So I suspect there will be further developments on this in the days ahead.
Great stuff. Thanks, Mark. Now, the Chancellor has played down the chances of big tax cuts in his budget on Wednesday, but Jeremy Hunt is reportedly considering a last-minute further cut to public spending to help boost any tax giveaways this week. Touring the TV studios yesterday, the Chancellor admitted the economic outlook was not as positive as it had been ahead of the autumn statement in November. Well, I've been speaking with David Livingston. He's Chief Client Officer at the Wall Street banking giant Citi, and began by asking what he was expecting to see on Wednesday.
What we expect the Chancellor to do this week is, of course, take account of some of the very small degrees of freedom that he has to operate fiscally. If you look at the the 5-year forecast, he's got about £18 billion pounds of fiscal headroom. That's not a great deal in a budget which is over £1.2 trillion spent every year by the government. So he'll use some of that. I think he'll have some measures to increase some taxation marginally, but also to be able to release either in national insurance reduction or in some tax rate reduction. But what he really should be focusing on, of course, is the expenditure side of the budget, the very significant. I mean, now the government expenditure is over 45% of GDP. That's very, very high relative to historic numbers. And that's really where the game is, and how to control expenditure, and particularly to do that because growth is not a given, and growth forecasts are probably on the weak side.
Obviously, his predecessor had an unfortunate experience with the markets when he played fast and loose fiscally. Do you think Jeremy Hunt has credit with the markets?
I think of course, the bond markets, and that's the thing to which you refer. I think we need to remember that it was also the inflexibility in the LDI segment of the pensions market, which also contributed to that significant change in the gilts market that we experienced a year or so ago. I think it's a different situation now, but all indications are that the Chancellor will remain within the Office of Budget Responsibility sort of guidelines that are there. So I think that will be the main measure that will be taken into account.
Now, when we last spoke, you were announcing a major refurbishment of your European headquarters of Canary Wharf. Since then, Citi has announced a significant number of job losses. Do you remain as committed to London as you were?
You've put two things together which aren't really together, and I would say that, of course, we're committed to London. London is the most vibrant and international of capital markets, not just in this time zone, but around the world. So, yes, our headquarters that we are refurbishing, a very significant financial commitment to London, but also an employment commitment to London. You may know, since we last spoke, I think we have 3,000 people more in London than we did then. We have over 11,000 people. And so we need a physical footprint which matches that human footprint. And so, yes, we remain fully committed to London.
Now, you've also just taken on a new job. You're now Chief Client Officer
Yes.
of the bank. What does that entail and why was the job created?
Well, we announced a management sort of restructure, reorganisation in September, really directed towards our structure catching up with our strategy. And we'd laid out our strategy 3 years ago. That remains unchanged. We are a very significant global player, as you know. And we confirmed the 5 business lines that we were pursuing: banking, services, markets, wealth, and our personal banking business in the US. And we elevated all those businesses to report directly to the CEO. But the other thing we did, and we knew that we needed to focus on, was to become even more client-centric as an organisation. So my role in the client organisation, which I lead, is a group of about 6,000 people with significant capabilities to bring a horizontal perspective to the delivery to our clients, to make sure that we're bringing the best of each of our businesses, but in a very coordinated way, which is beneficial to satisfy client needs. So that's the purpose.
And as part of this management reorganisation, you've just made a very, very high-profile hire indeed here in London. Yes. You've just poached Viz Raghavan from JP Morgan. What does that say about Citi's ambitions in this space?
So Viz will be coming in to lead our banking business globally. So that includes investment banking, corporate banking, commercial banking. It covers the full range of segments that we have. But what it says, Ian, I think, is that we have always positioned ourselves as being a major banking player, but we have ambitions to be stronger. It's about, banking ranges between about 7 or 10% of our overall revenue as a group, a significant component, and one where we have ambitions to be more effective and to continue to grow, but most important, make sure that we're serving our clients. But it is a very strong statement of ambition in that segment.
Now, 2023 was quite a tough year for investment banking. There was not much M&A activity. There was a dearth of IPOs. Do you detect more signs of life so far this year?
Well, as you know, the debt markets have been very, very strong this year, and I think there's been both in investment grade, but also emerging in leveraged finance, and some much stronger market conditions in 24 than in 23. M&A and ECM, as you know, potentially more sensitive to the outlook for sort of economic activity and confidence. And we are seeing, certainly in equity markets, and equity markets in this time zone, Europe in particular at 52-week highs, I think there is more confidence that the equity markets will provide a sound footing for sellers to be able to bring IPOs or to bring accelerated offerings to market. So quite positive on the ECM. M&A, as you know, can be a little bit more fickle. We're seeing sort of certain signs of life. There have been about 10 quarters of muted activity in M&A, and that's a long period. And with more certainty on interest rate outlook, inflation outlook, and potentially growth outlook, I think corporate leaders will be more confident, whether buying or selling, that this is a good time to act on M&A.
Are you surprised at how robust activity has been in the debt markets and how well equity markets have performed, given that interest rate expectations have really been quite significantly recalibrated since the start of the year?
Yes, but if you think about it from a funding point of view, if you're in need of liquidity, I think the spreads coming in has been the main component. As obviously absolute levels are set off the sovereign, but I think corporate treasurers or whatever, or financial institutions and funders, they need to know they've got the liquidity. So no, not surprised that they've taken advantage. The expectation, of course, is for the curve to continue to flatten, but that is something which is they need to act now to make sure that they have the liquidity they need to run their operations.
It's recently been reported that you've reduced bonuses by 20% this year. Have you had a job maintaining morale? And are those reports accurate?
I have not seen those reports, so thank you, Ian. I think we have on the back of the confirmation of our strategy, the structure that we now have, which is the other byproduct, of course, is to make us faster in decision-making inside the organisation. And so we understand that any reorganisation which does unfortunately have some job losses associated with it, and some very good people, unfortunately, have left our organisation as a result. That does have an impact on morale, but we are committed to complete that by the end of this month, and then very much focused on the execution of the strategy from there.
That's David Livingstone from Citi speaking to me a little earlier this morning. Some other business news stories for you now. And the insurance giant Aviva is returning to the Lloyd's of London market for the first time in more than 2 decades. Aviva, which exited Lloyd's in 2000, is paying £242 million for Probitas, owner of a platform in the reinsurance market and which has exposure to one of the most profitable Lloyd's underwriters. Aviva first held talks to buy the business in 2022 and revived its interest last summer, but on both occasions a deal could not be reached. The health, environmental and safety technology company Halma is buying a Dutch healthcare business for £73 million. Rovers, based in Os in the southern Netherlands, designs and manufactures sample collection devices used in the prevention and diagnosis of cervical cancer. Mark Ronchetti, Halma's chief executive, said Rovers will broaden the range of markets we serve in women's health and further strengthen our healthcare sector's position in cancer diagnosis products. And the automotive engineering group Saeta has gone into administration, it said this morning. The company, based in Towcester in Northamptonshire, makes drivetrains and other components for electric vehicles and was once valued on the stock market at more than £100 million. But it put itself up for sale 2 weeks ago after warning it would not be able to continue trading in the absence of fresh funding. Well, Friday night's gains on Wall Street were followed by a largely positive session overnight for stocks in the Asia-Pacific region. The Nikkei in Tokyo hit a fresh all-time high and finished above 40,000 for the first time. In Europe, stocks have been largely positive this morning. Actually, no, they haven't. Look at that. That's all changed around since I waddled into the studio. Talking points this morning include Piraeus Bank. That's the third largest lender in Greece. Its shares are up some 3% in Athens, and that is after the sale of a 27% stake in the business by Greece's bank bailout fund was met with strong demand. Here in London, the FTSE 100 is also down right now, off just under, it's bang on 0.5% lower right now, in a broad-based sell-off. Some of the big dollar earners are weighing on the index. In percentage terms, the leading FTSE follow is Ocado, currently off by just over 5%. That is amid concerns over its relationship with its joint venture partner Marks & Spencer. You'll recall we reported on that last week. Ocado now threatening to take M&S to court. Another faller to mention this morning is Mondi, the print and packaging group. That is off just over 2.25% right now on reports that it may raise its offer for rival DS Smith. The leading blue chip gainer this morning in percentage terms is BT Group, currently up 1.75%. That is on the back of supportive broker comment. Outside the FTSE 100, Hypnosis Songs, that's fallen by 12% right now. That's on news that dividend payments have been suspended for the foreseeable future. Meanwhile, Senior, the aerospace engineer, that was ahead earlier on. It's now off 0.25%. It's hiked its payout today, following a near doubling of annual profits. On the foreign exchange markets, nice day for the pound. Sterling up 1/5 of 1% against the dollar, up by 1/6 of 1% or so against the euro. Single currency, meanwhile, up 1/6 of 1% or so against the greenback. As for the oil price, well, that hit its highest level for a month on Friday night, ahead of an expected decision by the OPEC Plus cartel at the weekend to extend production cuts. That pledge was duly delivered. Barrel of Brent crude currently changing hands at $83.32 a barrel. That's off just over 0.25% on the session. Well, joining me as ever on a Monday is Russ Mould, Investment Director at AJ Bell. Russ, good to see you this morning. Let's start with the oil price because, I mean, this move from OPEC was widely anticipated. It looks like the price travelled and now it's arrived, so it's fallen again.
Yeah, it's just pulled a little back. I mean, it's not too unchanged now from where it was a year ago, and there is a suspicion that OPEC is probably relatively happy with where it is. It helps them meet all of their bills. And equally, it doesn't impose too much of a tax upon consumers or corporations' pockets. So you could argue it's a relatively happy medium. OPEC and OPEC Plus, including Russia, may be happy with oil, but they probably aren't so thrilled about natural gas, where the price is back to where it was at its part of pandemic panic lows of 2020 and is down by nearly half over the past 12 months. And a lot of that is down to mild winters. A lot of countries, including the UK, have managed their demand relatively well and have found fresh sources of supply. So if you're looking at the oil majors results like BP and Shell, oil's hanging pretty tough for them, but gas is now, profits will be much weaker there.
Yeah, now looking at the equity markets, another solid session overnight for the Nikkei in Tokyo. Where will this all end?
Well, that's a really good question. It's only just got back to where it was 35 years ago. So in that respect, you've had to be very, very patient if you've toughed that out. I guess what's interesting is in Japan, you still have a central bank running negative interest rates and is still running a quantitative easing bond and share buying program. So that's a help. You do have changes in corporate governance on your side. You do have a lowly valuation. The one thing that's working against overseas investors, though, is the yen. So over the last 3 years, the Nikkei is up around 40%. But in sterling terms, for British-based investors, it's up 10%. So if you are looking to get involved in the Japanese market, do think about how weak monetary policy may be helping share prices, but it's also dragging the yen down. So you're not, you've got to make it, you sort of slightly pays your money, you takes your choice there.
Yeah, very good reminder to that, Russ. Now, closer to home, we've had an update from Hypnosis Songs again this morning. I mean, things just go from bad to worse for this business.
Yeah, sorry, I shouldn't pull a face, but you've obviously had you've got corporate governance concerns, there are litigation concerns, and now you've had a welcome independent review of the valuation of the music recording of the music assets. The bad news is that independent valuations come in about a third lower than where the company and its advisors had put that valuation back in September, and that's pre-tax. So if the company does look to sell any assets to reduce its $675 million debt mountain, there could be a tax liability there as well. So, 92 pence a share is the pre-tax valuation of the portfolio of assets. The share price is down at an all-time low of 50-odd p today. So, you can argue that, again, investors are taking no chances there. And I think the biggest hit of all was this was a company where the theory was they own the rights to all this fantastic catalogue of music. Just watch the royalties roll in. We'll then turn the royalties into dividends for you and everybody will get well. Now the company's saying no dividends for the foreseeable future because it's got this debt pile and its asset valuations are sinking.
Ross, would it be terribly unfair to say that this was really a product, this company, of a decade of ultra-low interest rates? I mean, everyone's looking for a yield, everyone was looking for return. I guess this highlights also the risk of buying very, very illiquid, hard-to-value assets.
Yeah, I mean, and I think they're both extremely valid points. And, as somebody who studied history many, many moons ago, I remember the Cambridge Economic History of Britain, J.H. Clapham's magisterial work, talking about blind capital seeking its 5%. And that was when interest rates were near zero in the 1840s. And then everybody fell over themselves to buy railway bonds, a lot of which turned out to be ultimately Ponzi schemes, or some of the railways went bust. So that is one of the unintended consequences of a very unusual period for interest rates, which may now be normalizing. So yes, again, the classic warning signs there. Don't overreach for yield. Some of these things do turn out to be too good to be true, and it unfortunately looks like this is one of them.
Yeah, so we'll wait to see how it plays out. Russ, got to leave it there. Good to talk to you as ever. Thank you. Still to come here on Business Live, how tech businesses are helping their clients improve productivity. Stay with us.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Welcome back. Now, when the Chancellor delivers his budget speech this week, you can expect to hear the word productivity a lot. Recent years have seen an explosion in tech businesses supporting clients to achieve greater productivity by improving processes such as workflow management and customer experience. Well, both the specialisms of Qualtrics, the software firm acquired last year by the US private equity group Silver Lake for $12.5 billion. Well, joining me now is Zig Serafin, Chief Executive of Qualtrics. Zig, welcome to you. I mean, this was one of the biggest private equity deals last year. Has life changed for you much since?
Frankly, it's been accelerating what we've been doing. I mean, having some of the top tech investors in the world behind us, backing us, I mean, they're supercharging the growth of the business. And what they saw is what we see, which is that XM, or experience management, is a top priority for business leaders. Every CEO I talk to these days views the data that gets produced from our system to be gold. In fact, one CEO told me that he feels like he hit the lottery using our system as a result of what he's able to do with it.
You've kind of preempted my next question, which is why has experience management become such a hot topic of late?
Well, it's a hot topic because top of mind for CEOs is cost savings, advancing productivity of their workforce, and driving revenue growth. And what Qualtrics does is we get at the heart of what customers are thinking, of what people are thinking, understanding what's around the corner, knowing what preferences people have, how to think about sentiment, and then be able to action on it.
It's not just customer experience, so you also do a lot of work around employee engagement.
We sure do. In fact, the frontline workforce is top of mind for people these days, which is how do you best enable the employee understand what their preferences are, what their needs are, in order to be able to put them in the best position to be able to serve your customer.
I know you measure this very, very carefully. Which sectors are doing a good job? Which businesses are doing a good job in terms of employee retention and employee engagement?
You know, it's quite varied. Every industry has a leader within that industry who is able to command a premium for their service and for the way that they bring experience to life. But from financial services through airlines, travel, hospitality, we have customers all around the world. And what's interesting is to see the CEOs that take experience seriously are usually able to command a premium in their market, and they're the leaders that ultimately end up setting the pace.
You make it sound pretty obvious. Why wouldn't someone necessarily be focused on this?
Well, a lot of the way that businesses have been built is, they have separate departments. You have a separate call center. You have a separate digital operation for your apps and for your website. You have a separate frontline operation, right, with employees. And what you really have to do is take a moment and operate the company from an outside-in perspective. Consider what your customers are thinking. Better understand how to get your arms around the way that they want to communicate. These days, how we communicate as customers, how you communicate as a customer varies. You know, sometimes it's the information that you provide without ever being asked a question. Other times it's being able to ask the question at the right time, and then how quickly someone ends up acting on it really makes all the difference.
AI is also very, very hot right now. I think you're committed to investing something like $500 million in the business in AI over the next 4 years. What sort of things are you doing?
Well, it's an interesting topic. We have the world's largest sentiment database. How people express their preferences, what their interests are, their emotions, their disinterests. And so AI is only as good as the data that you actually are building the models on top of that. And then frankly, what really matters is how do you actually end up creating a workflow and an actioning capability that helps you to be able to go and deliver on the promises that customers would expect.
Are you seeing inflation in AI investment? Is it something where costs are going up because of demand?
Well, I see that there's certainly a lot of demand, a lot of interest in it. But at the end of the day, what I'm finding is customers value the ability to be able to go and drive cost savings, to drive productivity, to be able to and drive their revenue growth. So there's certainly a lot of hoopla out there, so to speak, and energy that people are putting behind it. But the difference will be people that have purpose-built AI to be able to go and drive business outcomes.
All right, Zig, we have to leave it there. Good to talk to you this morning. Thanks very much for joining. I know you've got a whistle-stop tour of Europe, so we appreciate you dropping in today.
Thank you.
That's it for me for the time being. I will be back this afternoon at 4:30. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, it's Kamali Melbourne. Thanks for joining me today. See you at 4:30. Cheerio.
Good afternoon. It is 12 o'clock. This is Sky News Today, your headlines. The Chancellor, Jeremy Hunt, confirms he is looking to reduce taxes in Wednesday's budget, but those hoping for a big cut are likely to be disappointed.
We do want to move to a lower taxed economy, but we're only going to do so in a way that is responsible.
Also ahead, calls for an immediate ceasefire in Gaza from the US Vice President as a member of Israel's war cabinet heads to Washington and talks to end the fighting falter.
For all the innocent people in Gaza who are suffering from what is clearly a humanitarian catastrophe.
A state of emergency declared in Haiti after a weekend of violence following jailbreaks at the country's two largest prisons. The captain of Wycombe Wanderers, one of the few British Jews playing professional football, tells Sky News he's become a target for hatred. Plus, a dazzling display as the Northern Lights brighten the skies over Scotland and further south. Good afternoon, thanks for being with us. The Chancellor has confirmed that he is looking to cut taxes again in Wednesday's budget, but has played down the chances of substantial reductions, insisting he needs to act responsibly. Jeremy Hunt is reportedly considering further cuts to public spending in an effort to boost any giveaways in what will be the government's